Here's why you should be worried about China's debt crisis. After decades of close double-digit development, Chinese pioneers have turned to utilize turbocharged boost financing to preserve direct development. As a result of this technique, it's been a sensational and quick rise in debt. As of 2017, China's add-up to debt measured 255.7% of its net household item, GDP, whereas a debt-to-GDP ratio exceeding 100% isn't bizarre, since China's credit development over the past decade has risen so rapidly. This drift has contributed to developing monetary vulnerabilities that seem to undermine the long-term well-being of its economy. Hello and welcome to Economic Stories. Join our channel by hitting subscribe and clicking the bell icon to be updated on our new uploads. Without further ado, let's dive in. Even though China was less influenced by the 2008 to 2009 worldwide money-related crisis than other nations, its economy still endured from a sharp decrease in trades and a major stock showcase redress that wiped out and evaluated two-thirds of its advertising value. To stem the tide of the crisis, China pushed out an enormous $600 billion jolt package in the late 2008 to boost residential requests and goad financial development. The value of the boost was near to 13% of China's GDP in 2008 and was impressively bigger than jolt bundles advertised by the world's, to begin with, and third biggest economies. The US and Japan pumped a comparatively scanty $152 billion and $100 billion separately into their much bigger residential markets. The government jolt was to be a great extent supported through advances from the state keeping money framework, which contributed to an increment in the obligation that with time has gotten to be unevenly disseminated over distinctive business and districts. Debt in household. Household debt in China expanded by 18.5% of GDP every year between 2008 and 2017, coming to 48.4% of GDP by 2017. This rate is marginally above those of developing showcase economies, with household debt averaging 40% of GDP. Government debts. This alludes to common debt owed by the Chinese central government, as well as that unequivocally held by nearby governments, which as a percent of its GDP rose from 27.1% in 2008 to 47% in 2017. China's government debt is marginally bigger than that of South Korea at 40.1%, but is overshadowed by the joined together states 97.1% and Japan at 201%. Even though China's common government obligation is moderately low, there are a few concerns that a noteworthy sum of debt has been amassed by local governments within the wake of the financial crisis. Corporate debts. China's corporate debt has risen strongly since 2008, hopping as a percent of GDP by over 60 rate focuses over the last 8 years. As of 2017, China's corporate obligation stood at 160.3%, setting it behind Hong Kong's 232.2%, but well ahead of Japan at 99.9% and the United States at 73%. So also, China's corporate credit levels have outperformed those of the rising market peers like Brazil at 43.9% and Malaysia at 67.3%. China's impressively high level of corporate debt presents a new challenge for its economy. We value your enthusiasm. Just a humble reminder, don't forget to subscribe to our Economic Stories YouTube channel and ring the bell to be informed about new episodes, and keep watching. Explaining debt. A 2015 McKinsey report appeared that around the world, debt has consistently risen and most major economies have shown higher levels of borrowing since 2007. Agreeing to the founded of Worldwide Fund, worldwide debt summed to $247 trillion. That's 318% of the worldwide GDP within the moment quarter of 2018. This increment was generally due to a surge in emerging market borrowing. Within the case of China, simple access to credit taking after the budgetary emergency cleared the way for large-scale investing for residential framework and real estate advancement. This investing fling moreover contributed to more noteworthy abroad investments. More concerning than the sum of debt China carries is the rate at which its add-up has developed since the monetary crisis. China's add-up development averaged a rate of around 20% per year between 2009 and 2015. In specific, China's high level of corporate debt is troubling. Chinese corporate use, the proportion of debt to value, has relentlessly risen since the financial crisis, demonstrating that Chinese firms are progressively utilizing credit to fund resources and taking on the expanded hazard. China's corporate segment is additionally tormented by issue credits. The IMF gauges that 15.5% of all commercial bank credits to China's corporate segment can be considered at risk where a firm's profit cannot adequately cover the intrigued cost of its credits. Accepting a 60% misfortune proportion, the IMF estimates that there are at-risk credits and they seem to result in losses to rise to 7% in China's GDP. Per the World Bank, China's non-performing credits summed to 1.74% of adding up to net credits in 2017, which is higher than the joined together states, that's 1.1%, but altogether littler than India's extent of non-performing credits, which sits at 10%. Notably, large banks just like the Bank of China detailed progressing non-performing advance proportions within the, to begin with, half of 2017. This result is mostly due to the offloading of terrible resources to companies like China's Sinda Resource Administration, the second largest of 4 resource directors set up within the 1990s to clean up terrible loans to improve the image of China. Concerns over the well-being of China's budgetary framework have provoked the universal financial community to reply. In May 2017, Moody's Investor Administration cut China's sovereign debt rating for a primary time since 1989, pegging it down one rank from A3 to A1. In reaction, China's Service of BAC called the Moody's downgrade inappropriate and pointed towards the ongoing structural changes, examined underneath, outlined to curb the obligation issue. In September 2017, Standard & Poor's Budgetary Administration's LLC2 cut China's credit rating from AAA- to A+, announcing that a delayed period of solid credit development has expanded China's financial and monetary risks. A 2016 IMF report appeared that of the 43 economies whose credit to GDP proportion developed by at slightest 30 rate focuses within the final 5 a long time, 38 of them experienced extreme disturbances, showed in money-related emergencies, development slowdowns, or both. China's add credit to GDP over the final 5 a long time, that's 2012 to 2017, developed by 48.4 rate focuses. It's hazy in case this mounting concern will materialize within the shape of a lull or emergency, but either possibility might be annihilating for both China and the rest of the world economy, through which China is integrals connected. A campaign by the central bank to tame genuine domain obligation and decrease the keeping money sector's presentation to disturb designers ought to mean that an Evergrande failure would have less of an effect on the budgetary system. The reality may be more complicated. Panic from financial specialists and domestic buyers may spill over into genuine bequest showcases and hit costs, influencing family riches and certainty. It may moreover shake worldwide money-related and make it harder for other Chinese companies to proceed to fund their businesses with remote ventures. Spectators and presently observing to see how Beijing handles the following chapter of Evergrande for what it says almost the countries eagerly to clean up the country's corporate division by letting debt bombs like Evergrande collapse. The Chinese government has taken up certain methods to control the looming crisis but hasn't been that effective. Outside investors are presently stressed that the money they are owed may be stuck in China and will be troublesome to extricate. In any insolvency continuing, they would be low on the list of leasers to induce any of the Chinese company's assets. Some, in any case, are more idealistic. China Inc. must be able to proceed to raise cash from remote investors, so Beijing will make beyond any doubt that bondholders can recuperate a few of their misfortunes. The consideration goes, foreign investors are owed $1.3 billion in US bond installments this month, and by April of another year, that figure will rise to $17 billion, concurring to one assessment. Now that we've reached the end of the video, wait, make sure to leave a like and subscribe so you can join the squad and be a part of the channel. Till we meet again, keep investing, keep loving, and don't forget to keep your family. It's your friend signing off. Thanks for watching. Adios.